are losing their shine. Bond prices show that emerging market debt is in the throes of its biggest decline in nearly 5 years. I'm Natalie MacDonald, bringing you today's press review. Prices on bonds issued in emerging countries have lost 9.5% of their value since an all-time record high in May. According to the JP Morgan Emerging Market Bond Index, the pace of the sell-off echoes that of 2008, where EM bonds sank almost 30% in under 2 months. While the latest decline was triggered by that all-important Federal Reserve tapering announcement, slow growth in EM economies and concerns that EM debt has become overvalued have also contributed to the $5.57 billion withdrawn from emerging market bond funds in the week ending June the 26th, marking not only the 5th week of consecutive outflows, but also the largest removal of funds on record. It's thought that sentiment is unlikely to U-turn once the market stabilizes. Sergio Tripaz of BlackRock, an organization which has cut its exposure to emerging market debt, comments, "We're not heading for an emerging market debt crisis, but the tide is moving slowly but surely in the opposite direction." Trends highlight that investors are advocating more selectivity in their country allocation, establishing which countries are likely to offer the best prospects. It's anticipated that some regions will begin to outshine others. Amongst those still expected to draw investors is Brazil. The removal of some taxation measures on financial transactions in recent weeks has boosted the appeal of Brazilian debt, particularly when compared with Indian bonds, which, despite their similar yields, trade against a weaker economic backdrop. And the losers? Tim Dinkmans of Adelante Asset Management states, commodity exporters like Chile and Indonesia are going to continue to be under pressure. We are also worried about Turkey because of the political instability. That's all we've got time for right now. You've been watching Dukascopy TV. Goodbye for now.